Hello everyone. Let's start with the very quick revision of the basic concepts. First of all, what is the purpose of the government imposing the taxes? It's a very good revenue for the government. It's a very good source of revenue for the government. The types of taxes leads to direct tax and indirect tax. Direct tax is imposed on the wealth of the wealth of the individual, the wealth of the person. In case of indirect tax, it is imposed on goods or services. Now there should be someone who should be giving the power. No, that power is the government. The government is given the power in the constitution in the article 246 in the form of union list, state list and concurrent list. When it comes to the income tax components, when you get a doubt with regarding to certain questions in income tax, you first go and search in Income Tax Act 1961, and then you will go and look into the Finance Act. What is Finance Act? See, Finance Minister introduces the finance bill into the parliament, then it get passed with both the houses of the parliament, and it gets the assent, that is nothing but the signature of the president. Then it becomes the Finance Act. The finance bill, after it is passed and gets signed by the president, this becomes the Finance Act. Okay, based on that, every year the respective amendments are also being made. And then you will go and look into the income tax rules. This is the brother of Income Tax Act 1961, wherein it states about certain specific things over here. Circulars and notifications gives the extra clarification with regarding to certain information which is there in the act or which is there in the rules. Notifications are also similar. Legal decisions of the court is also considered. If you can't find the solution elsewhere, then you can last resort, you will come to the court case or the court decision, and you will see which is most favorable to you, and obviously you're going to take the same. When it comes to definition, remember assessee means any person who's liable to pay the tax. Assessment is the procedure of calculating whatever the income tax you have computed is correct or wrong. Person is on whom the tax is being imposed. A person can be individual human beings, HF, joint family, basically companies divided into domestic company and foreign companies. All Indian companies are domestic company. Company which makes an arrangement to issue the dividend apart from the Indian companies will be domestic company. What are Indian companies? The companies which have been formed in India, that is the head office is in India and it has been registered under 1960 or 1956 or 1961 of the Companies Act. Firm, the partnership firm which has been legally registered, which has a legal binding. If it doesn't have a legal binding, then it is called as AOP, local authority. The municipality, the corporations will be coming under the local authority. AJP, artificial juridical person. These are separate entities in the eyes of law. Example, college, public institutions, etc. Income definition is very vast. It includes gains, it includes profit, it includes contribution, it includes capital gains, etc. And the definition of India covers the territory of India, the territorial waters of India, the continental shelf, exclusive economic zone, and any other maritime zone. Assessment year is the year in which you are paying the taxes. Money moves out of your pocket in the assessment year, but the previous year is the year in which you earn income for which you are going to pay the tax in assessment year. Clear? But there are certain situations, certain exception rule wherein you are going to pay the tax in the previous year itself. You will not wait for the government, and the department is not ready to wait for the assessment year to collect the tax. Such a sort of shipping business of a non-resident, because once this fellow leaves India, it is very hard to catch him. Hence, person living in India, similar situations. AJP, this AOP, POI, AJP, they are forming together for a particular event. They will form, suppose let's consider they will form for some 15 days, they will do a small business. They have invested 1 lakh rupees each, and now they have got 1.5 lakh rupees return. Three people have started the business. These three people have bought this form together for a particular people. These three people will divide 50,000 among themselves and they will go. And person likely to transfer the property to avoid tax and discontinued business. Once this fellow is closing the business and going, the department is like, "Are you pay the tax and go home permanently?" No, say tata bye bye to the taxes permanently and then go directly in the previous year and the previous year itself. Don't wait for the assessment year. Undisclosed sources of income. Remember, this is very important because if the assessing officer treats your income as undisclosed source of income, then the tax rate which is applicable is going to be 60% plus surcharge plus HEC at the rate of 4%. It is going to be not a very small amount. It will take a huge turnout. That is 60% flat tax rate plus surcharge of 25% plus HEC of 4%, and the surcharge effective tax rate would become 78%. Clear? Now, cash credits, unexplained investment, unexplained money, amount of investments, unexplained expenditure, amount borrowed or repaid on hundi, all these are going to be considered as your undisclosed sources of income. Clear? The rates of tax, surcharge and cess. When it comes to the tax rate, HEC is always at the rate of 4%, irrespective of the person. For individuals, AJP, HUF, AOP, BOI, AJP. For the age, this is a normal provision, optional tax regime, not a default tax regime. This is an optional tax regime. Okay. For non-senior citizens being the resident in India for less than 60 years, it is not 60 years or more. Exactly 60 is not covered here. Exactly 60 is covered over here. 60 is not exactly included. It has been included. If you want the notes of whatever you are seeing, this notes is available in my Telegram channel. You can go join and you get the free resources. Okay. For non-senior citizens, being the resident individuals of the last 60 years, 60 years not included, up to 2.5 lakh nil, 2.5 lakh to 5 lakh it is going to be 5%, 5 lakh to 10 lakh it is 20%, about 10 lakh it is going to be 30%. People, what we are doing is a super quick revision, that is, it's going to help you, you have already done your studies once. Then it will be, this revision series will be very much helpful for you. Okay. For senior citizen being resident in India at the age of 60 years or more, but less than 80 years. 60 years not included, but 60 years is included, but 80 years is not included. Basic exemption limit is increased to 3 lakh. That is up to 3 lakh. There is no tax. 3 lakh to 5 lakh 5%, 5 lakh to 10 lakh 20%, and about 10 lakh it's going to be 30%. For resident individuals at the age of 80 or more at any time during the PY, ATS is also included. Up to 5 lakh rupees, the tax rate is nil. 5 lakh to 10 lakh, the tax rate is at the rate of 20%. About 10 lakh, it is at the rate of 30%. There are special rates of tax that you need to consider. That is section 112. 112 long-term capital gain, which is other than long-term capital gain, taxable under 112A, because 112A has a separate tax application. 112 is a basic long-term capital gain, basic section wherein you are going to pay tax only at the rate of 20%. 112A speaks about listed equity shares, listed business trust, listed units of the equity-oriented unit fund, wherein you are going to pay the tax only at the rate of 10% on excess of 1 lakh rupees. 111 is the brother of 112, wherein this is a long term. This is the listed equity shares, listed units of equity oriented fund, listed business trust, which is short term by nature, which you are going to consider it at the rate of 15%. 115 BB speaks about winning from lotteries, crossword puzzles, race horses, card games, gambling, betting, etc. 115 BBJ is the net winnings from the online games. 115 BBE is unexplained expenditure, which is coming at the rate of 60%. Undisclosed sources of income we've already covered. Default tax regime under section 115 BAC of the Income Tax Act 1961. Default tax regime, when I'm speaking about default tax regime, this has multiple names. See, if you have a name, you will be having some nicknames. You'll be having like Chinnu, Sonu, Monu, so many nicknames. Similarly, 115 PAC also has so many names. It is called as default tax regime. It is called as concessional tax rate. It is called as 115 BAC. Opting out of default tax regime, that comes under your normal provision. So these terms are used interchangeably as 115 BAC. Here, there is no age criteria required. It is just that one slab is given for everyone. If you're opting for 115 BC, then you will opt for this. That is up to 3 lakh, 3 lakh to 6 lakh, 6 lakh to 9 lakh, and then 9 lakh to 12 lakh, and then 12 lakh to 15 lakh. That is, and above 15 lakh rupees, it is going to be 30%. 3 lakh to 6 lakh is 5%, 6 to 9 is 10%. How you are going to remember this? Very simple. It is the difference of 3 to 6, 6 to 9, 9 to 12, 12 to 15, and 15. Here it is going to be 5, 10, 15, 20, and 30%. Clear? Following are the conditions that need to be satisfied, that is 115 BAC. In order, if the department is stating, okay, you pay the tax at the lower rate, but they are not going to give at a cost. Now, there are certain things, if you want to pay less tax, you have to forego certain deductions or exemption. That is, you cannot take the deductions or exemptions. What are those? Leave travel concession you can't take. HRA you can't take. Special exemption, special allowances which is coming under section 1014 you can't take. Daily allowances for the constituency for MP/MLS you can't take. Exemption for the minor child that you can't take. Tax holiday, that is 10AA you can't take. Entertainment allowance can't be taken. Professional tax can't be taken. Interest to loan for self-occupied property only. This also can't be taken. Additional depreciation you can't take. But however, you can take the normal depreciation. Normal depreciation is allowed, but you can't take additional depreciation. Deduction for scientific research contributions, that is section 35 expenditure on scientific research. So certain things you can't take. 35 it is specified business exemption you can't take. And ATC to ATU, except certain things you can't take over here also. What is the timeline for you to, can you opt in and opt out for default tax regime? How you can do that is that if I'm a person, like a good fellow, I'm going to the office, I'm coming back, I'm an employee and I'm getting salary, I don't have any business income. In that case, I can switch 115 BSC into normal provisions year on year. I don't have any problem. If I'm having income from business or profession, then if I opt in for 115 BSC once, I have to stay over there. If I opt out of it, then again I can't opt in for 115 BSC until and unless I don't have any business income. Clear? Great. When it comes to surcharge, see, a surcharge is a tax on tax. It's an additional tax imposed on your income tax if your income crosses certain level. If you want a detailed explanation about the surcharge, there's a separate video particularly recorded for surcharge. That link will be provided in the description. You can go on watch it. Okay. In case of individuals, HUF, AOP, BOI, AJP pays tax under default tax regime, where the total income, including the dividend or the capital gain, is exceeding 50 lakh but less than or equal to 1 crore. The surcharge that would be applicable is at 10%. Where your total income including dividend and those capital gain income is crossing 1 crore but less than or equal to 2 crore, it is going to be taxable. It is going to be, surcharge will be applicable at the rate of 15%. Where your total income excluding your dividend or the capital gain income is exceeding 2 crores, it is going to be 25%. The rate of surcharge, see, if whatever the excluded income over year you have, no, if that is going to be considered as inclusive, sorry, if whatever the amount which is been excluded over here, that excluded income surcharge cannot exceed 15%. That is what they state. Where the total income including the dividend and the capital gain income, which is not covered under any other cases above, is crossing 2 crore, then you have to pay surcharge at the rate of 15% only. I told you more explanation about the surcharge. If you want a detailed explanation, separate video is that you can go and watch. Okay. With regarding to 115 BAC, that is option to excise out of the 115 BAC. Now you are in the normal optional tax regime or the normal tax regime. What is the surcharge? How is the surcharge going to be applicable? Is that where your total income including your dividend and the capital gain income, that is if it is greater than 50 lakh but less than or equal to 1 crore. If it is greater than 50 lakh but less than or equal to 1 crore, it is going to be, the rate shall be at the rate of 10%. Where your total income including the dividend and the capital gain income is greater than 1 crore but less than or equal to 2 crore, the surcharge will be at the rate of 15%. Where your total income excluding your dividend and the capital gain income is greater than 2 crore but less than or equal to 5 crore, it is going to be 25%. And the excluded dividend income and the capital gain income, the surcharge can't exceed 15%. If your total income excluding the dividend and the capital gain income is already more than 5 crore, the surcharge which would be applicable is at the 37%. That excluded income surcharge cannot exceed 15%. Clear? So when it comes to marginal relief, people always remember marginal relief is given to you when the tax paid is higher than the excess of income which you're earning. So suppose up to 50 lakh rupees you don't have any surcharge. No. Just because your income has crossed that border, suppose your income is 50 lakh 10,000 rupees. Because of the 10,000 rupees which has been your income which is added, you will end up paying surcharge for the income tax of almost a 10% for the entire 50 lakh 10,000. So whatever the tax you're paying is 30,000, suppose extra tax which you're paying is 30,000 and the extra income is only 10,000. Now they will give you a relief to the extent of that 20,000 rupees. So how is it going to be? Just look into this example, you will clearly understand. 50 lakh 10,000 rupees is the income. Okay, first you will calculate as though how much is your actual tax payable for that entire 50 lakh 10,000. Compute the income tax, add surcharge, don't add HEC. Add surcharge, you are supposed to pay 14 lakh 47,000 as per the 50 lakh 10,000 rupees income. Now compute the income tax as though your income is only 50 lakh. If your income is only 50 lakh rupees, what is the surcharge that you were supposed to, what is the income tax that you were supposed to pay is 13 lakh 12,500. Can I say whatever I do, I can't escape the tax of 13 lakh 12,500 that is supposed to be paid. Now, the third step would be to calculate what is the extra income on which, because of which you are paying extra tax, that is 10,000. Now, you will add the income which you can't escape plus the income for which you are going to pay the extra tax. The total is going to be 30 lakh 22,000. This is something fair tax that you are supposed to pay. Just because you had an increase of income excess of this one 10,000 rupees, you were ending up paying the difference of 1,24,550 rupees extra, which is given as your surcharge. Clear? If your step number 1 is greater than your step number 4, then the marginal relief would be step number 1 minus your step number 4. Then you will get your marginal relief. Then you will calculate the tax liability, add HAC, and this would become your marginal relief. If you want the notes of this, again, it is there in my Telegram channel. You can find it over there. Comes to firm, local authority, etc., the income tax which is supposed to be paid by them is the 30%, and the surcharge which is applicable if the total income, if the firm's total income exceeds 1 crore, surcharge which is supposed to be paid is only 12% of the income. Cooperative society has a slab rate up to 10,000. You have to pay 10% of the tax, 10,000 to 20,000. You have to pay 20% of the tax, and about 20,000 you have to pay 30% of the tax. And remember, there's a special provisions which is given, that is 115 BAE and BAD. 115 BAE you are supposed to pay 15% of the tax, and 115 BAD you are supposed to pay 22% of the total income. 22% of the total income as your tax. Cooperative society surcharge, that is for the normal slab, not for the special provisions. For the slab, if the total income is above 1 crore but less than or equal to 10 crores, 7% of the income tax. If it is above 10 crores, it is going to be 12% of the income tax. If the cooperative society has opted for 115 BAD and 115 BAE, then your cooperative societies would be taxable at the rate of 10% as a surcharge. Domestic company, remember, if the turnover exceeds or the gross receipts exceeds in the PY 21-22, that is less than or equal to 400 crores, the tax which you are supposed to pay is 25%. If it is excess of that in any other situation, you are supposed to pay 30% of the total income as your tax. Companies, that is the domestic company, has an option to opt in for special provisions 115 BAB and 115 BAA for the tax payment, for the tax applicability. 115 BAB, if you're opting in for, then 15% of your total income would be the tax. 115 BAA would be 22% of the income tax. Then the surcharge which would be payable would be, the surcharge that would be payable will always be for special provisions 10% of the income tax. In case of the domestic company, normal provisions, the normal provisions being applied. If your income is above 1 crore but exceeding 1 crore but less than or equal to 10 crores, 7% of the income tax. Above or 10 crores, 12% of the income tax, similar to that of your cooperative society. Your surcharge is the same. Okay. So in case of foreign company, the tax rate which would be applicable is 40% and the surcharge would be 1 crore. If the income exceeds 1 crore but less than or equal to 10 crores, it is going to be 2%. If it is above 10 crores, it is going to be 5%. Rebate for the resident individual shall be coming under section 87A. If you are the person who has opted in for 115 BAC, if your total income is up to 7 lakh rupees, then your rebate would be income tax payable or 20 to 25,000, whichever is less. Optional tax regime in case of normal provisions, if your total income is up to 5 lakh rupees, then your whatever the income tax payable or 12,500, whichever is less, would be the rebate for that individual. Remember, this is for resident individual. Non-resident can't take advantage of this section, and only individuals can take advantage of this section. No HF, no companies can take advantage of this section. Okay, agricultural income would, if you can derive agricultural income as per the Income Tax Act, the definition would cover the revenue which has been generated from the land situated in India and used for agricultural purpose. If you are generated this income from or agriculture, or you are renting this agricultural land for agricultural purpose, would also be considered, and you are cultivating any agricultural produce would also be considered for the purpose of agricultural income. What if you have agricultural and non-agricultural income? How the calculation would go is that very simple steps here. Compute, first of all, you are going to compute the total income tax which is payable considering everything, agriculture, non-agriculture. Step number 2 would be, as though you have only agricultural income and basic exemption limit. However, if you had these two, you wouldn't pay any tax. To what amount you wouldn't pay any tax? Now you will subtract what you are now supposed to pay minus what you're not supposed to pay at all. You will subtract these two, whatever the amount which you get, you will add it to 4%. This is your basic concepts. So this residential status and the scope of total income. Remember, section 6 speaks about the residential status of individuals and HF for that matter, and the other residents as well. For individuals and HF, we have ROR, RNOR, and NR. For other residents, apart from individuals and HF, we have only two categories, resident and non-resident. How are you going to determine the residential status of individuals? Is that based on the basic conditions and based on the additional conditions. Basic condition is that first basic condition, he has been in India for a period of 182 days or more, exactly 182 or more. If he has not satisfied this condition, then you can look into the second basic condition. That is, he has satisfied, he has been in India for a period of last 4 PY. Last 4 PY doesn't include the relevant PY, it includes the preceding previous years and backwards 4 years. He has been in that period, he has been in the last 4 years for a total period of 365 days or more, or he has been in India for at least 60 days in the relevant previous year. If any one condition is satisfied, then he's going to be called as resident. If both the conditions not satisfied, he will be called as non-resident. For the days of calculations of the number of days he was present, consider the day he was present, consider the day he was absent. That is, he left India. Consider the day he was in India, consider the day he had left in India, because he was there in the Indian landmass for that particular day, even for a single minute would be considered as one entire day for the purpose of calculation. Now, when it comes to this basic conditions, we have seen that any one basic conditions need to be satisfied. But there are two such situations. There are certain situations wherein you are going to look only first basic condition, second basic condition you are not even going to touch. That is, you are going to see whether that fellow has stayed for 182 days or more. Who's that? Indian citizen who leaves India for the purpose of being a crew member in an Indian ship or for the purpose of employment outside India. Is present in India for a period of 182 days or more, resident, not present, then no basic conditions, you directly are going to consider, no second basic condition, directly you are going to treat him as non-resident. Now, when an Indian citizen or a person of an Indian origin, Indian citizen means the person who was born in India. Person of Indian origin means his parents or his grandparents are born in India, is staying outside India only but comes on a visit during the relevant PY and is having the Indian income other than the foreign source income which is exceeding 15 lakh rupees. That fellow will be treated as a resident if he has satisfied the first basic condition, that is stay in India for a 182 days or more. Fine. If he has not satisfied this condition, we will look into the second basic condition, that is he has stayed in India for a last 4 PY for 365 days or more, or at least 120 days. Here 365 days or more, at least 60 days in the relevant PY. Instead of 60, it has been replaced by 120. Clear? And when it comes to the deemed resident concept, this fellow where he is earning the income exceeding 15 lakh rupees apart from the foreign source income, but is not considered as resident for the purpose of taxing this income elsewhere, he would be considered as resident in India for the purpose of taxation. Always remember, this deemed resident will always be treated as RNOR only, resident but not ordinary resident. In order to say, okay, that fellow is resident and ordinary resident, resident but not ordinary resident, you generally speaking, you need to look into additional condition. But for deemed resident, you are not going to look into the additional conditions at all. Additional condition, if both the conditions over here are satisfied, then you are going to consider him as ROR. If any one condition is not satisfied, you are not going to consider him as ROR. You would be treating him as RNOR. One such condition is that wherein he is staying for a period, wherein he is a resident, not staying, resident in India for a period of 2 years out of last 10 PY. Not relevant to PY, preceding that last 10 PY, he was a resident. If or and he has stayed in India for last 7, immediately preceding the PY. 7 last years, he has stayed for a period of 730 days or more. Any one condition not satisfied, he would be treated as RNOR. Both conditions satisfied, he would be treated as ROR. But there is one certain situation, two certain situation wherein you are not even going to touch the additional condition. Directly you are going to treat him as RNOR. One such is deemed resident. And the second situation is that you had seen a person, Indian citizen or an Indian origin, no, that fellow having income greater than 15 lakh rupees. If he stayed for 120 days but is not stayed for a period more than 182 days but stayed for 180 days but not more, 120 days or more, but he has stayed for a period less than 182 days during the previous year, then he would be considered as resident but not ordinary resident. Okay. In case of residential status of HF, it's very simple. If the control and the management of the affairs is situated wholly or partly in India, you would be treated as resident. If it is only outside India, you would be treated as non-resident. But in order for HF to be treated as ROR or RNOR, we have to see the residential status of Karta. If this fellow Karta is ROR, HF is also ROR. If this Karta is RNOR, you are going to treat HF as RNOR. Clear? Residential status of the firm AOPBO is similar to that of your previously what you have seen. Control the management is outside India, non-resident. In India, resident. Companies, for that matter, companies are every Indian company is a resident. The place of effective management in that year is in India. Then also it is going to be as resident. More about the companies you are going to look into the finance. So let's move forward. Residential status of local authority and the artificial juridical person also as a similar thing. If the control and the management of the affairs is situated in India, if only or partly in India it is considered as resident, only outside India it is going to be considered as non-resident. Comes to the scope of total income people, it is divided into two major income, that is Indian income and foreign income. Indian income has four classification, that is income received in India, deemed to be received in India, accrued in India, deemed to be accrued or arise in India. Any income apart from this would be considered as foreign income. Okay. For individuals and HF, we have three classifications. So ROR, RNOR, and NR. Apart from individuals and HF, every other thing has only resident and non-resident classification. Indian income for ROR would always be taxable. Foreign income, that is where business is set up in India, would always be taxable for ROR. Any foreign income is taxable for ROR. It means global income is taxable. Every income for that matter, until and unless an exemption is given in income tax, would become taxable for ROR. When it comes to RNOR, Indian income would be taxable. Foreign income where the business is set up and established in India would be taxable, and other foreign income would not be taxable. In case of NR, Indian income is taxable and foreign income as a whole becomes not taxable. For other assessors, Indian income is taxable and for non-resident also it's taxable. Foreign income for resident would be taxable. However, for non-resident it would not be taxable. Section 7 speaks about income received or deemed to be received in India, wherein the contribution in excess of 12% of the salary or to a recognized provident fund or interest credited in excess of 9.5% per annum would be considered as income deemed to be received in India. We have seen the point, no, contribution in excess of 12% of the salary, it is taxable under the head income from salary, and interest credited in excess of 9% becomes taxable under RPF, salary chapter. Contribution which is made by the central government, that is by other or any other employer under the pension scheme under section 80 CCD would become taxable. Amount transferred from unrecognized provident fund to recognized provident fund also becomes taxable because it would be considered as deemed to be received. Income received means income received for the first time. It can be in cash or in kind. Income accrued or arised in India means originated. The origination, the source is in India. Deemed means, always remember the deemed means by default, the concept of default. Income by default, how it would be considered as accrued or arised is that it is plain explained in section 9, subsection 1. 9 subsection 1 clause 1 states that whatever which is income is accrued, originated outside India, directly or indirectly, where business connection is established because of which you have got that income, or there is a property in India, or you have transferred such property in India. Any one thing you have done and you have got the income outside India also, it is deemed to be accrued or arised in India. It would be taxable in India. Section 9 subsection 1 clause 2 speaks about salary earned for the services which are rendered in India. 9 subsection 1 clause 3 speaks about salary which is payable by the government to Indian citizens for services rendered outside India. The simple example for such one is embassy. That is where the salary is payable by the government to Indian citizen. Government pays to the Indian citizen for the services which is rendered outside India. 9 subsection 1 clause 4 speaks about dividend which is paid by the Indian company outside India would be considered as deemed to be accrued or arised in India. Section 9 subsection 1 clause 5 clause 6 and clause 7, all these three concern interest, royalty and fees for technical services. If it is payable by, I'm not telling received, I'm speaking about payable by. If it is payable by a person resident in India, or if it is payable by government, or if it is payable by a non-resident, how we are going to consider it as deemed to be accrued or arised is that if the person resident in India, it is going to be taxable. Normally speaking, it is going to be accrued or arised in India only. But there are two exceptions wherein in these two situations, you are not going to consider not deemed to be accrued or arised in India. wherein the money which you have borrowed or the technical services which you have utilized for the purpose of business or profession which you're carrying outside India or making any sort of income outside India, in that case, whatever the money which you pay, that doesn't become income, that doesn't become to the person who receive accrued or arised in India. In case of garment, in case of totally the garment, it is government pays for any situation, any person for that matter, it is going to be completely accrued or arised in India, deemed to be accrued or arised in India. If a non-resident is paying the interest, royalty, or fees for technical services, it shall be considered as accrued, deemed to be accrued or arised only in two situations, wherein if the money is borrowed and used for the purpose of business or profession in India or making any source of income from India, in those two situations, it will be considered as deemed to be accrued or arised in India. Income deemed to accrue or arise in India, Section 9, subsection 1, Clause 8 speaks about income arising outside India being any sum money, that is basically gift given to non-resident or to foreign company, where the sum of the gift which you have given is greater than 50,000 rupees. What you have given is greater than 50,000, it is going to be civil. So, with this income from the head salaries, when the salary is going to be taxable is that when there is an employee-employee relationship exists and you're getting some compensation in return, that is nothing but your salary. It will be taxable and you get income from salary. And now comes the question, what if I work part-time? What if I work full-time? Whatever might be the work. If it's an employment and the employer-employee relationship exists, then it is going to be considered under the head salaries. Okay. Now, what if I surrender my salary to the employer? Even though you surrender your salary, your income would still be taxable. But however, if you surrender your salary to the central government, it will not be taxable. Place of accrual of the salary, we have seen some. We have seen this section 9, subsection 1, clause 2, wherein you are earning salary for rendering services in India, and there are certain situations wherein the exemption would be provided, that is under section 10, subsection 6, clause 2. That is remuneration which is received by the officials of the embassies, etc., of the foreign states. Whatever the official, are officials receiving money over there, and remuneration received by the officials of the embassies of the foreign state. That is the person who is an official of the foreign state embassy. That fellow, whatever the remuneration which is paid by that respective country for rendering services in India would not be considered for the purpose of tax, or it would not be taxable, or exemption would be provided these two satisfaction, these two conditions are satisfied. What are those conditions? Similar remunerations received by our government official in that foreign country is exempted, and the staff members, whosoever the staff members are there, and those foreign country, whosoever are the foreign, whosoever is the person who's working over here, that fellow should not be engaged in any other business or employment in India. In that situation, it is going to be considered as not taxable. It is exempted under Section 10, subsection 6, clause 2 for these officials. Section 10, subsection 6, clause 6 speaks about remuneration received for the services rendered in India as an employee of the foreign enterprises. What does it mean? Remuneration which is received by the foreign official. These people, whatever they are receiving the remuneration for rendering service in India as an employee of a foreign enterprise, it would be exempted provided a condition satisfies three conditions. What are those? The foreign enterprises which we are speaking about, that doesn't conduct any business or trade in India. Or the employee stay in India does not exceed 90 days in the previous year. Or the remuneration is not deductible from the employer's taxable income in India. That would be the point. Section 10, subsection 6, clause 8 speaks about whatever the salary which is received by a non-citizen, non-resident for the services rendered in connection with the employment of a foreign ship. This is going to be exempted if he does not stay for a period exceeding 90 days during the previous year. Section 10, subsection 6, clause 11 speaks about whatever the remuneration which is received by the foreign government employees when they are staying in India for specified training. In that case, it is going to be exempted. And this would be the format. You can go through once. This, whatever the content you could see, that content is available in the Telegram channel. The link is provided in the description. You can join and you can take the free resources. Good. See, salary is taxable either on due basis or receipt basis, whichever is earlier. If it is due in the month of March, but it is received in the month of April, as it is received, as it is due first, we would tax it in the income in the year in which the March falls in. That is, salary is taxable on due basis or the receipt basis, whichever is earlier. Clear? Suppose if it is advance salary. See, there is difference between advance salary and advance against salary. See, advance salary means you are receiving 2 months salary in advance. Today only you are receiving. Today, this is the month of December. You are receiving the salary of Jan month and the Feb month. In the December only, that is advance salary. Advance against salary means you are receiving some loan amount from the employer, giving the guarantee as a salary, but you are going to repay that loan amount back. No, that is advance against the salary. Your advance salary is taxable on the due basis, obviously. Due, obviously, receipt will come first. So, receipt basis or due basis, whichever is earlier it would. Arrears of salary, always remember it must be charged on due basis only. Arrears of salary charged on due basis only. Section 17, that is the salary perquisite and the profits in lieu of the salary, comes with section 17(1), 17(2), 17(3). Wages means, always remember, wages are fully taxable and wages can be considered as the regular payments earned for work or service. What is it? Wages considered, these are regular payments. Wages can be interchangeably used as salary, basic salary, and wages interchangeably used. Allowances means something which you're getting fixed remuneration, fixed monetary benefit which you're getting, it's called as allowances. Remember, TNS allowances are first of all fully taxable, and those comes with the two things, that is DA in terms and DA not in terms. In the question, if they provide DA within the bracket, it is called as in terms. Terms means forming part of retirement benefits. Not in terms means not forming part of retirement benefits. Overtime allowances, these are fully taxable. Fixed medical allowance, fully taxable. Interim allowance, fully taxable. Project allowance, fully taxable. Warden allowance, fully taxable. Non-practicing allowance, fully taxable. Remember this point, this becomes important. Tiffin, lunch and the dinner allowances are fully taxable. There's a purpose for this one at that point of time. Don't get confused. Tiffin, lunch and dinner are fully taxable. City compensatory allowances is given. It is also considered to be fully taxable. Basically, these are given to the employees to cope up with the higher cost of living would be there. Over there, they can cope up with it. Fully taxable. Entertainment allowances are fully taxable, but an exemption, a deduction is given to the government employees only, that we will see later. Transport allowances are fully taxable. However, transport allowance which is given to deaf, dumb, handicap employees are exempted up to 3,200 per month and debtors. Exempted. Helper allowance, research allowance, and uniform allowance. These are section 10, subsection 14, clause 1. These allowances are fully exempted. That is, these are fully exempted to that extent of actual expenses income. Suppose you have incurred some 20,000 rupees as helper allowance, and uh, the helper allowance given by the organization is 45,000, but your actual allowance is actual money spent for this helper of the domestic services which you have taken is 20,000. So difference between these two, 25,000 would become taxable. It means you actually spend something from your pocket for helper, research and uniform allowance. To that extent only it is exempted. Apart from that, everything else would become taxable. No. Allowances which is payable outside India under section 10(7). For the embassy people outside India, if you are paying, it is going to be not considered as taxable. Allowances and perquisites are exempted. In subsection 14 clause 3, which becomes important, that is special compensatory allowance rupees 200 per month. Employees in the transport system may receive an allowances for the personal expenses during the work related travel, that is 70% of such allowance or 10,000 per month, whichever is lower. Children education allowance rupees 100 per month per child up to a maximum of 2 children, and children hostel allowances 3 rupees 300 per month per child up to a maximum of 2 children. Remember, these two becomes important. Children education allowance and children hostel allowance. Children education allowance rupees 100 per month per child. Children hostel allowance rupees 300 per month per child. It is going to be exempted. Transport allowance in case of deaf, dumb, blind, up to 3,200 per month is fully exempted. The section 10, subsection 13A, HRA, house rent allowance. Lower of the following is going to be exempted. That is the HRA actually received for the relevant period, rent paid minus 10% of the salary, or 50% or 40% of the salary for the relevant period. Lower of the following is going to be exempted. I'm just doing the revision over here, so I'm not going in a very detailed manner. Lower of the following is exempted. Repeat. HRA. HRA actually receive rent paid minus 10% of the salary, 50% or the 40% of the salary. 50% or 40% when do you consider? 50% in case of metro cities and 40% in case of non-metro cities. Okay. 40% in case of non-metro cities. Metro cities covers Delhi, Kolkata, Mumbai and Chennai. Remember, if you want to claim 1013A, then you should not opt for 115 BSc, because opting for 115 BSc, we have to leave the deduction, you have to leave the exemption under section 1013A for that matter. And salary, for the salary definition for the purpose of HRA would be basic salary plus DA provided in terms. Remember, this is in terms plus turnover commission. Plus turnover commission. Remember, turnover commission is a fixed turnover of fixed percentage of turnover, not a profit commission, not any other. It is a fixed percentage of turnover. Now, when it comes to your pension, pension is nothing but pension, something which you are receiving after your retirement. It can be on two terms. That is, basically, we will receive it on retirement. It can be in two terms, commuted and uncommuted. Commuted means you are receiving it in lump sum. Uncommuted means you are receiving it in a periodic basis. It can be in monthly term, it can be quarterly, it can be semi-annually, it can be annually. You are receiving it in a perfect periodic intervals. When it comes to pension, remember, when it is lump sum, you are receiving it in one shot. Government employee, lucky people for life, fully exempted. Other employees, you have received the gratuity, not received the gratuity. 2 point counts. So if you have received the gratuity, it is exempted. That is 1/3 of the total pension, commuted plus uncommuted. When it comes to your other employees, you have to consider two things: receive gratuity, not receive the gratuity. Correct? When it comes to receive the gratuity, remember, exempted income will be 1/3 of the total pension. Total pension is commuted plus uncommuted. If you have not received the gratuity, exempted income will be half of the total pension, again commuted plus uncommuted. Received gratuity 1/3, not received the gratuity 1/2. Remember this point very well. Uncommuted pension shall be fully taxable for both government and other employees. It is going to be fully taxable. Clear? When it comes to your gratuity, if you have received it during service, it is fully taxable. Gratuity, if it is received at the time of retirement or at the time of death, for government employees, it is going to be fully exempted. For other employees, if it is covered under POGA, Payment of Gratuity Act 1972, if they are not covered under the Payment of Gratuity Act 1972, if they are covered under the Payment of Gratuity Act 1972, then least of the following would be considered as your exemption. What are those? 20 lakh rupees or actual gratuity amount which you have received, or 15/26 into last drawn salary into completed year of service, plus if you have worked for a period excess of 6 months, then it would be rounded off to the entire part. 15/26 into last drawn salary into completed year of service or part in excess of 6 months. Least of the following would be considered as exemption if it is not covered under POGA 1972. That is 20 lakh. Actual gratuity received half of the salary for the completed year of service, and in this case the fractions are ignored for your non-POGA. In case of non-POGA, fractions are ignored. In case of POGA, fractions are there. That is, excess of 6 months are considered as 1 year rounded. Excess of 6 months are not considered as 1 year rounded up. You are going to go back. You are not going to round up to the 1. Here it is 15/26. Here it is 1/2. It is last drawn salary over here. It is just the salary. This salary is considered as the average salary. We'll speak about it. And in case of POGA, for the purpose of salary definition for POGA, it is very simple. Basic plus DA. For this POGA, which is nothing but in terms and not in terms. Both are considered. Both. Here, this is for POGA and this is both DA in terms, not in terms. In case of salary, for the purpose of a non-POGA, average of the basic salary, average of DA in terms plus average of the turnover commission for the last 10 months we have to take. Average of basic salary plus DA in terms plus turnover commission for the last 10 months. Remember, you have to take the average for the purpose of the salary definition over here. Clear? Now, when it comes to your leave encashment, it is provided under section 10, subsection 10 double A. Leave encashment during the employment and received on retirement. If it is during the employment, fully taxable. If it is during the retirement by a government employee, it is going to be fully exempted. By any other employee for that matter, it is going to be least of the following would be exempted. That is 5 lakh rupees or leave salary actually received, or this is not 5 lakh rupees people, this is 25 lakh. Okay. 5 lakh rupees or leave salary actually received, or 10 months of the average salary of the last 10 months unavailable. So 25 lakh and leave salary actually received. 10 months you will multiply by taking the average of the salary of the last 10 months. Salary for the purpose would be basic plus DA plus turnover commission. Whatever you have calculated in non-POGA, you would do the similar calculation over year as well. Then multiplied by 10, giving the 10 months equivalent point over there. Unavailed leave shall be leave allowed minus leave taken, which is nothing but the average salary of the last 10 months, which is nothing but the average salary of the last 10 months. Provident fund. The types of provident fund would be recognized provident fund, unrecognized provident fund, statutory provident fund, and public provident fund. What are these recognized provident fund? Recognized by the Commissioner of Income Tax. Unrecognized, not recognized by the Commissioner of Income Tax. Statutory provident fund. It is usually government based provident fund. Public provident fund, anyone can put into this provident fund, usually maintained by the government. So now, in case of employer's contribution, remember, in case of SPF, employer's contribution of SPF would be fully exempted, and you would get the ATC deduction in case of the employee's contribution. Interest credited would be fully exempted for the purpose of your for statutory provident fund. Whatever the amount which you are withdrawing at the time of retirement or during the termination, it would be exempted under section 10(11) for statutory provident fund. In case of recognized provident fund exempted, this point becomes very important, wherein it becomes exempted up to 12%. Excess of 12% becomes taxable. Up to 12% it's exempted. Excess of 12% it would become taxable. Suppose if it is 14%, up to 12% it would be exempted. That excess of that 12%, 2% for that matter would become taxable. Eligible for the deduction under section ATC, exempted up to 9.5%. If you are having any interest income, that is interest credited towards the employers and the employees provident fund, it is exempted up to how much? 9.5% per annum. 9.5% here, 9.5% here. And exempted up to 10 subsection 12, subject to the conditions if you have withdrawn on retirement or in case of termination. Clear? And in case of unrecognized provident fund, at the time of employer making a contribution, it is not taxable. At the time of employee making contribution, no deduction, ATC deduction is not available. And interest credited on employees and employer contribution, it is not taxable at the time of that amount being credited, but it is going to be taxable at the time when you are withdrawn. That is, interest employees contribution is not taxable. See, employee contribution, employer contribution, interest on employee, interest on employer contribution. These are the four incomes that you might get. Employee contribution is not taxable. Interest on employee's contribution would be taxable under the and other sources. Employer's contribution and the interest on the employee's contribution would be taxable under the head salary. It is taxable, fine, but it is taxable under which head would be the point. Clear? PPF, it is not so relevant in this point because PPF is something which you are paying as a self-employment basis. So there is no difference as employee-employer contribution for the matter. When it comes to your RPF, Recognized Provident Fund, you have to look into one point. That is, has the employee provided continuous 5-year services with the employer? Answer is yes. After then you withdraw certain amount, it is going to be fully exempt. If the answer is no, then you have withdrawn because of certain reason. One, because of the ill health, or because of the employer itself discontinued the business. Where will the provident fund come from here? Business itself is discontinued. Making sense? So any other thing which is caused beyond the control of the employer. But if the answer is yes, exempted. If the answer is no, then you have to think whether he has joined for another employer, whether he has joined for another employer wherein he has transferred the balance to them. If the answer is yes, exempted. If the answer is no, it is going to be taxable. Clear? AD, this section wherein you making any contribution to this pension scheme which is mentioned over here, ATCCD. Employer making any contribution to the NPS would form part of the salary first, and then you would take the deduction under section ATCCD 2. ATCCH, employer making any contribution, would first be added to my income, to my employees' income, and then later on it would become taxable. Later on, you would get the deduction. Section 10, subsection 10b, retrenchment compensation, wherein lower of the following would be exempted. What is that? What is that compensation? As per the Industrial Dispute Act, that is nothing but 15 by 26 into average salary of the last 3 months only, into number of years of completion of service. Fractions, if it is more than 6 months, then it is rounded off to 1. Salary for the purpose would be basic plus DA plus turnover commission. When it comes to your voluntary retirement receipts, lower of the following is exempted. That is the salary per month into 3 months into number of years of completion of service, or salary per month into number of remaining months of service, or the actual amount received, or the maximum of 5 lakh. Salary is equal to basic plus DA in terms plus turnover commission. Now, when it comes to perquisites can be something. Usually, it will be in kind. That is, if it is non-monetary in basis, then we call it as perquisite. Perquisite in exam, perquisite for that matter. Remember one point, that is, there is something called as tax-free perquisite in all cases. That is, whatever you do, these services you are getting as an employee, then it is absolutely going to be exempted. What are those? Telephone which are provided by the employer at the employee's residence. There is no tax, it's a tax-free purpose. Transport facility provided by employer. Village tickets which is provided to the employees, to the Indian Railway employees. Purpose it provided outside India by the government to the Indian citizen working abroad. That is 10.7 you have seen. No, similar point is provided here. Employer's contribution to group step insurance. Employer paying annual premium on the personal accident insurance cover. Refreshment provided in the office. Subsidized lunch up to 50 rupees per meal. It's going to be exempted. Recreational facilities which is provided to employees, and the employer spending on the training of the employees is also considered as exempted. Clear? It's all these are tax free purpose here. Even though you receive it, you're not going to make it as taxable. Now, when it comes to 10.5, that is leave travel concession, leave travel concessionally, what you're going to say is that travel by air, lower of the following is travel. Travel by air, lower of the following is going to be exempted. That is actual expenses of the economy class fare. Lower of the following would be the exemption available in case of traveling. Okay. If you're traveling by air, this would be the case. If you're traveling in any other mode, that is in railway services, actual expenses or the AC class first rail fare, whichever is lower. Where the rail facility itself is not available, then you're going to see if is there any recognized system of education. Sorry, is there any recognized system of transportation? If the answer is yes, lower of the following actual expenses or the class or the deluxe class fare expenses, whichever is less. If there is no recognized system of transportation also, you would cover as though if the transportation had happened to a similar distance through railway, what would have been expenses that would have been incurred? That expenses you would consider actual expenses or the EC class fare, whichever is lower. That would be considered as leave travel concession. Remember, if the leave travel concession is maximum provided to spouse, to himself, to the employee, spouse, maximum of two children, parents and siblings. When in case of children, this point becomes important. If it is twins which are born first, then exemption, and the second child, and the second born is one child and the first born is the twin. In that case, maximum for two children, the exemption would be provided. What if the first born is one child and the second born is twins? In this case, exemption is available for all the three children. Clear? Medical facilities which should be considered, the medical facility which is provided to employee or any other member of the family are exempted from tax, provided value of the medical treatment in employer's hospital, government, whatever this facility which are provided are first of all exempted. Employer reimbursing, that is giving medical treatment in employer's own hospital, is exempted. Reimbursement of the medical treatment had happened from the employer's organization, wherein the employee had joined, or the employer had made their family member to join in government hospital, or government this recognized hospital, or if it was the illness because of the COVID-19, or if the premium for the health insurance has been paid by the employee, half employee is paid by the employer directly. Any reimbursement of health insurance premium which has been paid by the employee, reimbursement happened by the employer, payment of the premium on the personal accident cover, all these things are covered. If these things are covered by the employer, the divine person, God person only employer doing all such things, then it is going to be exempted. Great. Expenditure on the medical treatment outside India for employee, that is the medical treatment. If the medical treatment is given for an employee outside India, then medical treatment for the employee or his family, stay or travel expenses, and the travel and stay expenses for one attendant accompanying the patient. These are the expenses which are incurred. In this case, whatever is the expenditure on the medical treatment and the stay in the abroad, the exemption is available to that extent provided by the RB. Travel expenses for the patient and the attendant are exempted if the employee's GTI doesn't exceed 2 lakh rupees. This is the provision. Section 17 subsection 2 clause 3 speaks about purposes which are taxable only in the case of specified employees. The same purpose is given for other than specified employees. It is not taxable. First of all, who are specified employee? Director, the person who is having substantial interest in the company, and the poor fellow, that is employee drawing in excess of 50,000 rupees salary. In this case, these people are covered as specified employees. These services given to specified employee becomes taxable. These purposes given for other than specified employees doesn't become taxable. That's the point. Clear? Providing services like the sweeper, gardener, the personal attendant, these services are provided by the employer to employee. Giving accessories to utilities like gas, electricity, water supplied, etc. Offering free or discounted price. Allowing use of the company owned car. Providing free or the discounted educational facilities for that. In case of RFA people, rent free accommodation. See, government, if the services are given to, if the RFE is given to the government employee, it will be taxable based on the license be determined by the government. If it is for other employee owned by the employer for that matter, 5%, 7.5%, and 10% as reduced by the rent paid by employee, like whatever the amount I've given, 5% comes to if the employee is being given the RFA, rent free accommodation, in the place where the population is less than 15 lakh, 5% of the salary would be considered as RFA taxable amount. 7.5% in case the population is between 15 lakh to 40 lakh. 10% in case if it is exceeding 40 lakh. Other employee, in case of the rent by employer, lower of the following would be considered as the lower of the following would be considered as the taxable amount, actual amount or 10% of the salary as reduced by whatever recovery has been done. Clear? And in case of the furniture which is provided by the employee, if it is owned by employer, the whatever would be the taxable amount would be 10% of the cost of furniture. If it is hired by employer, it would become the higher charges. So when it comes to the car facility which has been provided, that is the motor car facility, if the car is used fully for official purpose, it is going to be fully exempted. If the car is used by the employee fully for personal purpose, if it is owned by the employer, then 10% of the cost would be considered as the taxable purpose for the employee. If it is hired by employer, whatever is the higher charges, that would be considered as the taxable for the employer. And if the driver is also given, 900 per month would be considered as the driver's, that would be considered as the purposes that need to be added by the employee. And running and maintenance charges, whatever is actually provided. If it is paid by employer, then it will be considered as amount to be taxed by the employer. And if it is partly used for official purpose and partly used for personal purpose over here, then what happens is that if it is, now we have to see whether the car is owned by employee or employer. If the car is owned exclusively by the employee and the car is employees, running and the maintenance charges is also employees. Where is the benefit they are getting here? There is no benefit, hence there is no tax. If this car is owned by employee and the expenses is being borne by employer, then whatever the running and maintenance charges if that employer is paying, and you are getting a deduction 1,800 per month or 2,400 per month. Because people, if you observe something, 1,800 per month, 1,800, and whatever the amount of exemption that you're getting, that deduction that you're getting, is because of the car is owned by employee. Car is mine. Running and maintenance charges is paid by employer. But the car is used, my personal car is used for this purpose also. No? So, is it not ideal for me to get certain deductions? Yes. 1,800 per month or 2,400 per month. 1,800 per month up to 1,600 cc. 2,400 per month, that is more than 1,600 cc would be considered. If it is employer running at the maintenance charges, if it is paid by employee, the taxable amount would be 600 or 900 per month. The 1600 cc, 600 rupees, more than 1600 cubic capacity, 900 per month. If it is an employee, the taxable amount would be 1800 per month and 2400 per month, which is more than 1600 cc. If the employer also provided driver, then 900 per month should be added to the above taxable amount as usual. So now if the transport facility is given for the transport employees, for airlines it is taxable. That is, for airline employees it is going to be exempted, fully exempted. For other employees it's going to be fully taxable. When it comes to education facility, remember for employee it is going to be fully exempted. Employer providing education facility for the employee, it is going to be fully exempted. If it is for children, it is going to be exempted. If the value of education which is provided by the employee, it is not more than 1000 rupees per month, and the education is also provided in the employer's own organization or the institution, and for other relatives, it is going to be fully taxable. And in case of the interest free or the concessional loan which is provided, the loan which has been provided by the employer to the employee at a concessional rate. That is, in the market, if you go, SBI rate is 18%, but the employer is offering only 10%. So your actual benefit is going to be 6% which you are getting over there. That 6% of concessional interest or free interest free loan which you are getting is nothing but the purpose that you would be considered for the purpose of taxing. That is loan amount multiplied by interest charged by the SBI minus the interest charged by the employer you are going to consider. If the loan is taken for the purpose of the medical treatment of the critical illness, or the total amount of the loan does not exceed 20,000, then the interest free purpose should not be considered for the purpose of taxability. There is no purpose, hence there is no taxability. If you are going for the purpose of traveling, touring, or accommodation, the expenses which is paid or reimbursed by the holiday trip, total expenditure if it is incurred by the employer, if it is for the personal purpose, if it's for business purpose, it is going to be fully exempted because it's not going to be a purpose it only. Simple. So the facilities which is maintained by the employer and expenses for the household member of an official tour, whatever it is, if it is for personal purpose, it is fully whatever the expenses made by the employer should be considered as my taxable purpose. Free or concessional food or non-alcoholic beverages, it is exempted up to rupees 50 per meal. If it is exempted up to rupees 50. Exempted, that is tea, snacks, whatever it is given during the office hours, that is going to be exempted. If the gift is in cash, it is going to be fully taxable. If the gift is in kind, and if the fair market value, if the gift is less or up to 5,000, is less than 5,000, then it is fully exempted. Otherwise, it's going to be fully taxable. Excess of that is not taxable. It is going to be fully taxable. Credit card expenses, whatever is met by the employer to that extent of which is personal in nature, is going to be fully taxable. And use of mobile asset, remember, if this mobile assets are being used, that is employer giving you laptops and computers, it is going to be nil. There is no purpose. Employer giving you sofa, employer giving you furniture, employer giving you AC, all these things are going to be 10%. 10% of the actual cost of asset will be taxable. Transfer of movable asset. When it comes to transfer of movable asset, now the employer is owning it. Employer is transferring in your name. That transfer which is happening is the computer and electronic items. Depreciation of the 50% on WDV should be given and the remaining should be considered for the purpose of the purpose calculation. That remaining amount would be considered as the purpose. Motor car depreciation shall be taken at 20% on WDV. Any other asset apart from the motor cars and the computers, it is 10% depreciation on SLM. Remember, these two are WDV, this one is SLM. And valuation the specified security or the spec equity shares, number of shares, that is the fair market value minus the issue price. This would be considered as the fair market value. That would be considered as the purpose. Hotel benefit, lower of the following would be become taxable 24% of the salary or actual charges. Whatever is its salary, the salary definition is covered in RFA. The RFA, whatever the salary definition is covered, the same thing is covered over here in hotel benefit also. Deductions from the GTI, deductions from the gross salary. Standard deduction up to how much? Standard deduction up to 50,000 rupees. This is available irrespective of the regime, irrespective of the old provisions or the new provisions. It's available. 16, clause to entertainment allowance. This is going to be considered as least of the following is allowed as deduction. 5,000 or the 1 by 5th of the basic salary or the actual entertainment allowance, whichever is received, shall be considered as the entertainment. That it shall be considered as the deduction for this entertainment allowance available only in case of the government employees. Section 16 clause 3 speaks of the professional tax. Professional tax is nothing but your the tax which is deducted by the employer. And this professional tax, remember, professional tax can be paid by either by employer or employee. Remember the calculation. Professional tax paid by employer, first whatever is paid by the employer, that becomes your income added to your GTI first, and then you're going to take deduction. It is going to be added in your salary income, then you're going to take deduction under section 16 clause 3. What this professional tax is paid by employer, directly you're going to take deduction under section 16. Clear? And the relief is provided relief when the salary is paid in arrears or in advance. Step number one, you would calculate the tax payable which is paid in the previous year, in which the arrears or the advance salary is received. Then step number two, you would compute the difference in step number one and whatever the difference that you have calculated. Step number three would be to compute the tax payable of the every year, every previous year for which the additional salary was relating to. And step number four would be to calculate the difference between A and B in step three, and then to calculate to which the additional salary relates to. Step number five would be the relief under section 89(1), which wherein the amount which is calculated in step number two and the amount calculated in the step number four would be considered as the relief. Clear? So this video is about the revision of income from house property, and section 22 speaks about the chargeability of this income from house property. See here, section 22 speaks about the chargeability, that is house property. What do you mean by the house property is that if you're having this house property and if you're getting any rental income over here, that would be considered as income from house property. And what is meant by this house property is that it consists of any building or land, but remember, land has to be attached or connected with the building. It can't be a vacant land over here. It is land or building, and this building can be residential building, building can be factory building, building can be go downs, building can be other commercial premises, it can be anything. But it has to be a building, and when it comes to land, land can't be a vacant land, land has to be land attached to the building. And assessee must be the owner of the property. These are the conditions that need to be satisfied in order for the rental income received from the house property to be taxable under the head income from house property. Clear? And property should not be used by the owner. If the owner is using for residential purpose, we call it as SOP, self-occupied property. If the property is being used by the owner for the business purpose, then we are not going to call it as income from house property. We will not consider it under this. And property which is held as stock in trade, up 2 years if it is held as stock in trade, we are going to call, that is, we have the income from house property, GAV shall be considered as nil. The GAV, the annual value of the property, would be considered nil. After 2 years, the property which has not been sold, which is kept as stock in trade, shall be sold. That is, after 2 years, we are going to call it as DLOP, that is deemed to be let out property. What's the deemed to be let out property provision attracts? It attracts all the provisions which is applicable for the LOP property, for the let out property as well. Clear? Composite rent means the rent which you are going to receive along with the house property with the other assets in picture. That is, in case you have constructed a flat, and in this flats you are providing the other asset also. You are providing the TV, you are providing sofa, you are providing AC, and all these assets you are going to collect some rent, right? For providing it on the higher basis, you are going to collect some rent for that matter. And all these things you are collecting along with this flat charges, along with this house property, you are collecting this one. In that case, we are going to call this composite rent. So how are you going to determine this composite rent? To the extent it is attributable to income from house property, if it is inseparable. That is, if I'm stating you are coming and asking for the flat, and I'm stating if you want to if you want to take this flat on rent, you have to buy these assets also. In that case, what happens? Whatever the asset property which I'm giving along with the asset, it's a sort of a business income for me. So it is not going to be considered under income from house property. It is going to be considered under business income, and it is going to be considered under income from other sources. Okay. Separable letting means you're coming and asking me this flat for rent, and you're stating you don't want any accessories inside, you don't want any other assets inside. I'm stating okay, fine, you can take this particular flat on rent. In that case, whatever the income you're getting from letting out that building would be considered under the house property, and which you're getting outside, that is, if you are getting the asset, you are getting the rent from the assets also. In that case, you're going to consider it as PGBP. Clear? Great. In case of income from house property situated outside India, in case of ROR, it is going to be completely taxable if the property is even situated outside India and you are receiving any rental income also. Global income will be taxable for the resident, and for non-resident and for RNOR, it is taxable only if it is received in India. Okay. So how do you compute it? GAV minus municipal taxes, you will get NAV minus deduction under section 24, 24A, standard deduction at the rate of 30% of NAV, and interest on loan you are going to get, and the answer will be income from house properties. It's a simple concept. There's no complication in this chapter. How do you determine GAV? GAV shall be fair rent or the municipal rent, whichever is higher. The answer of step number 1 or the standard rent, whichever is lower. And whatever the answer which you got in your step number 2, that is expected rent or the actual rent shall be actual rent minus your whatever unrealized rent will always be subtracted from your actual rent. That becomes the outer column in your step number 3. Whichever is higher you would consider for the purpose of computing GAV. How do you determine GAV in case of the property being let out throughout the previous year? It's usual, whatever you have considered about. What if the let out property is vacant for part of that year? If it is let out property is vacant for the part of that year, then we are going to compute in a little bit different manner. That is, if the actual rent is less than the expected rent, that too because of vacancy, we are going to treat our GAV as your actual rent only. That is one provision. Okay. So now in case of the deemed to be let out property, if you own, suppose you own 3 property and you are considering all the 3 property as SOP. You have not let it out to anyone. You have considered all the 3 properties as SOP. But the provision states up to 2 properties, 1 and 2, up to 2 properties, you can consider it as your SOP. And beyond that, if you have 3rd property or 4th property, 5th property, beyond that, other properties shall be treated as DLOP. And there is no order for you to determine, okay, the first property which I bought should be SOP. Nothing like that. Any 2 property can be SOP. Apart from that, every other property shall be DLOP, that is deemed to be let out property. Clear? In case, remember, in case of the SOP property, the GAV will always be nil, municipal taxes will always be nil, NAV will always be nil, and 24A will always be nil as usual. 24B, if you have any interest on the borrowed capital, that we are going to see when we get into the 24B section. Now, in case of unrealized rent, always remember, unrealized rent is such that wherein the owner has tried his maximum effort from his side. What is this maximum effort? Is that tenancy is bona fide. That is, I have given the property on rental basis only. My intention is to collect the rent. So tenancy is bona fide, and defaulting tenant has not been. We have made all these steps. We have taken all these steps to make sure that the defaulting tenant has to vacate the property, but it was not successful. That person had not vacated the property. Or tenant not occupying other property. I'm not stating, Are you don't occupy this property, you're not paying rent. No, go and occupy some other property of mine. I'm not stating that. I genuinely want him to go away from the property so that, however, it is whatever the property, whatever the rent he was supposed to pay me, that is unrealized. But I can recover, or I can give the rent, that the property on rent for someone else to. So that's the point. Now, when it comes to the municipal taxes, always remember 2 points to be remembered in the municipal taxes. Municipal taxes you are going to consider only if it is actually paid by the assessee, owner only, not tenant. If it is paid by the owner, and it should be paid during the P1. It is not necessary that you are paying for the current year only. You can pay for the last year also. Whichever year you are paying the municipal taxes, that particular year you are going to consider that as municipal taxes deduction in your income from house property. Clear? It has to be paid. It shouldn't be payable. It has to be paid, and it can be paid for any year. Clear? Remember, subsequent year, that is next year's municipal taxes, if I am paying in this year only, I am not going to, we shouldn't consider that as a deduction in the income from house property. Point being very simple. Municipal taxes, if you are paying for the current year, if you are paying for the earlier years, you can take the deduction if it is actually paid. If you are paying for the next year, then you can't take the deduction because you have to take it in the next year only. Then, okay. Deductions from the annual value, section 24. Section 24A, 24B. 24A speaks about 30% of the standard deduction allowable on NAV, the property, that is to the LOP and SOP. But in SOP you don't have NAV, hence it is going to be 0. In case of LOP you will have 30% standard deduction irrespective of whether you incur the expenses or not. You will have 30% standard deduction. When it comes to section 24B, which is the most important point in income from house property, that is interest on borrowed capital. When you want take this interest as the deduction, you have to satisfy certain conditions. What are those? Very simple. Interest which is payable for this, the borrowed capital should be used for the purpose of acquisition, construction, repairs, renewal, reconstruction, etc. And interest which is paid on the new loan shall be taken if you have taken a new loan to repay the original loan, that the original loan was taken for the purpose of acquisition, construction or renewal or reconstruction of the property. In that situation, what happens? You can take the interest as the deduction for the new loan also, provided old loan was taken for the construction purpose. Clear? Interest for the pre-construction period shall be taken on 1/5 basis. On 1/5 basis. Interest on the pre-construction period would be considered like the same. When you're considering the interest that you're supposed to pay, always remember your period of calculation of interest for the pre-construction period would start from the loan borrow date or the construction commencement date, whichever is later. It would start from that time and it would end in the year. Suppose on 30th 9 2023 your period of construction is completed. It would be completed. That is pre-construction period stops on 31st March, just preceding the year in which you have completed your construction. Before this, immediately before this 31st March is 31st March 2023. No? So, it will start from the loan borrow date or the commencement of the construction date, whichever is later, to 31st March 2023 in my example. So, whatever the interest that you have considered, you will take it for 1/5 portion, that is 5 equal installment. You will take 1 lakh multiplied by 1/5. That is 5 year in equal installment you would consider, and you would take the pre-construction period interest to be the same. Post-construction period, you all of us know that you will take whatever is payable. It is not necessary to be paid. Whatever is payable, you will take it for the purpose of interest calculation. Clear? No. The interest deductions in respect of self-occupied or unoccupied where the annual value is nil. See, whenever you are considering the SOP, interest on SOP, that is interest on capital borrowed for the SOP property, please remember one point. In case of LOP or DLOP, it is fully allowed. Whatever amount is payable, entirely it is allowed. In case of SOP, you should keep one thing in mind. That is, you have to satisfy 3 conditions in order for your interest allowed to be 2 lakh rupees. That is, where the loan is taken for the purpose of acquisition, construction of house property only. Loan is taken on or after 1/4/1999 and the acquisition or the construction completed within 5 years from the end of the financial year in which the capital was borrowed. If all the 3 conditions are yes, the maximum would be 2 lakh rupees. If any one condition has not been satisfied, then maximum you can take deduction under interest on SOP shall be 30,000. And if the loan has been taken for the purpose of repair, renewal, reconstruction of the house property, the maximum you can take the deduction of 30,000 rupees. Clear? Maximum you can take only 30,000. Very good. In case of your 115 BAC, please remember one point. 115 BAC, you can't take the interest on a loan for self-occupied property. It is no deduction is allowed in this section. 24B, in case of you opted for 115 BAC. Apart from that, LOP, it is allowed as usual. Now, when it comes to section 25, that is inadmissible deductions, where the interest chargeable. TDS was supposed to be deducted, but you have not deducted the TDS. In that case, it will become that deduction will not be allowed. Wherein you have considered it as unrealized rent and you have decided that fellow will not give you the rental amount anymore. After some 3 years, he is coming and is providing and is giving whatever the rent was due way back then. Now, the unrealized rent is received. No? it has to be taxable in the year in which you receive it, and the standard deduction 30% will be allowed to you. Even though the property is not in your name, you have sold it last year only. Even though the property is not in your name, still it is taxable under the income from house property. Clear? And the treatment of income from co-owned property. In case of co-owned property, LOP, you don't have any problem because interest deduction is, however, available throughout. In case of SOP, please remember, if you have one property and the property is co-owned, that is 50-50%, has the spouse, husband and the wife owns that property, has a co-owned property. In that case, both will get the interest deduction. Both can take the deduction up to a maximum of 2 lakh rupees for the property. That is, for one individual, you will get 2 lakh rupees as the maximum deduction which is allowable for each of them. 2 lakh rupees or 30,000 as the case may be, depending on whether they are satisfied the condition. Now, okay, section 27 speaks about the deemed ownership. That is, even though it is not the, even though they are not the legal owner, who shall be held responsible for paying the amount, for paying the taxes for the property owned. Clear? So, in this concept of PGBP, let's make a quick revision of the PGBP here. See here, whenever you need to understand one thing in the PGBP, that is when the expenses increases, the profit decreases. Expenses decreases, profit increases. Income increases, profit increases. And income decreases, profit decreases. This is the basic element or the basic understanding that you need to have with regarding to your PGBP computation. Okay. Now, let's get into the provisions wherein the business or the profession means business is something which you wherein you're trading goods or goods for that matter, buying, manufacturing, the trading, everything is coming under business. Profession is something which you're dealing in services for that matter. When it comes to accounting, accounting are of two types, that is mercantile accounting and your cash basis of accounting. And the notified ICDs are ICDs 1, 2, 3, 4, 5, 6, 7, and these are the ICDs. Just remember the name, not so important. Section 28 speaks about the charging section, that is income chargeable under this particular head. Multiple incomes are chargeable under this head. Income from business or profession, any compensation or any other payment which is received or due to be received by. Income from specified services which is performed by its member by trade or professional business for that matter. And all those things, just give it a one time read. These are included under the definition, and section 28 is a charging section. Speculation business for that matter, where an SSC carries on speculation business, that business of the SSC must be deemed as distinct and separate from any other businesses. Speculative transactions means the transactions wherein means the transactions in which a contract for the purchase of or sales for a transaction is being done. Speculative transaction wherein the it is not, there is no actual delivery of the shares that is happening, where there is no actual delivery of the product that is happening. That sort of business is called as speculative businesses. Okay. So, section 29 speaks about the computation in PGBP, computation of the PGBP. Computation of the PGBP consists of the admissible deductions, that is coming up to from section 30 to 37. Inadmissible deduction, expense or the payments not deductible in certain circumstances. Section 30 to 37. And inadmissible deductions we will see one by one. Section 30 speaks about the rents, rates, taxes and the repairs and the insurance of the building. If the rent is paid by the tenant, it is going to be allowed as expenses. The cost of repairs and others, only revenue in nature is going to be allowed as expenses. If it is capital in nature, then you are going to add it to your cost of asset, then take the depreciation. Hence, the capital nature expenses are not considered as your expenses which is allowed under your PGBP. Section 31 speaks about the repairs and the insurance of the machinery and machinery, plant and furniture used for SSC's own business or current repairs of the capital nature are not allowed. Used for SSC's own business, this repairs and insurance of machinery, plant and machinery shall be considered if it is used for own business, and it shall be allowed if it is in case of the revenue expenses, capital expenses are not allowed. Section 32, which is very, very important, that is the depreciation. What you are going to do normally is that depreciation as per the P&L account is not allowed as per income tax. So you are going to add back and then you are going to deduct the depreciation as per the income tax. Depreciation as per the P&L account in Companies Act is not allowed. Hence you are going to add back that and then subtract the depreciation as per the income tax under your PGBP. Deductions on account of the depreciation shall be made compulsorily whether or not the SSC has claimed the deduction in computing his total income. Basically what will happen is that you are going to claim the deduction of the depreciation no matter what. It is a mandatory provision. It is not something option which is given. It is a mandatory provision. And if the assets are put to use for a period less than 180 days, half rate of the depreciation actually allowable. If it is 20%, 10% is allowable. If it is 10%, 5% is allowable. If it is equal to more than 180 days, if it is put to use for a period more than 180 days, then full rate of depreciation. If 20% is there, entire 20% is allowed, 40% is there, entire 40% is allowed for depreciation. Now, when it comes to your computation of the depreciation for that matter, always remember we are going to calculate the depreciation based on the block of the asset. Block of the asset means individual asset is going to lose its identity. Only block of assets would be coming into picture. And very important point to remember, you have only two methods, that is straight line basis and WDB basis. Straight line basis option is given only for the power generation undertaking. Option as such is given for power generation undertaking. Apart from that, no one else, no other organization has the option. Everyone has to follow WDB method only, and it comes under the block of assets. Assets are classified as tangible assets and intangible assets. Tangible assets, remember, very important point. Buildings are covered at the rate of 10%. The temporary structure, wooden structure are covered at the depreciation rate of 40%. When it comes to block 2, that is the furniture and fixtures, it has a general rate. It has one rate at 10%. Easy. Plant and machinery, motor cars in general category have 15% depreciation rate. And this specified air control, pollution control equipment, water pollution control equipment, solid waste control equipment, and solid waste recycling resource control equipment consist of 40% of the depreciation rate. Computers, including computer software, include 40% of the depreciation rate. Books include 40%. Plant and machinery in general include 15%. Intangible, always remember, it includes 25%. All these are the depreciation rate which you need to remember, given in the question very well. Majority of the time it is not given in the question, so you should remember all these points. Whatever we have covered is the important ones. Additional depreciation on the plant and machinery which is acquired. Remember, normal depreciation is given for 115 BSE under the normal provisions as well. But under your 115 BSE, additional depreciation is not available. That is default tax regime, additional depreciation not available. Optional tax regime, it is available. What is this additional depreciation? It is very simple. It is allowed on new machinery and plant only, and that too for manufacturing industries only, in the business of manufacturing or production of any article only. And the rate of depreciation which is allowable is the 20% of the actual cost of the asset. 20% of the actual cost of the asset means whatever is the cost of the asset, if it is 10 lakh, you are going to take 20% of it, 2 lakh as your depreciation. Suppose you have used it for a period equal to or more than 180 days, very well, you are going to take completely 20% depreciation allowable. What if you are used for a period less than 180 days, you are going to consider 10% of the depreciation rate to be allowed. That is, out of 20%, 10% is allowed in this year. What about the remaining 10%? That will be allowed in the next previous year. Next year, we are going to consider the remaining 10%, and that 10% will be on the actual cost of the asset, not on the WDV value. Remember, plant and machinery which is not qualifying for additional depreciation should be second hand plant and machinery installed in the office premises, installed in the residential, any guest house for that matter, office appliances or any plant and machinery. But actual cost is considered as deduction. All the situation, you cannot take additional depreciation even though it is used for the manufacturing business only, even though it is new plant and machinery only. If it comes under this point, then you can't take additional depreciation for that. However, normal depreciation would, however, normally be allowed. When it comes to actual cost of asset, that is section 43 subsection 1, always remember, if you have paid the cost, if you have paid the expenditure for acquiring an asset which is exceeding how much, which is exceeding 10,000 rupees, in an account pay check, account pay for other than account pay check, account pay draft, any other electronic clearance form. That is, in short, if you have paid it in cash, if you have paid it in cash, then what happens? Then your whatever the amount which you have paid in the form of cash. Suppose 2 lakh rupees is the value of the asset. You have paid 1,60,000 rupees in bank form, and you have paid 40,000 rupees in the cash form. This 40,000 rupees would not be considered or added to the actual cost of asset. Your actual cost of asset, even though the money actually paid is 2 lakh, still it is going to be considered as 1.6 lakh. That is the clear. When it comes to section 43 subsection 6, that is the written down value. Written down value is nothing but the WDV. How do you consider the WDV amount? How do you consider the WDV value would be the question. See, first of all, you are going to consider WDV value of the immediately preceding previous year. If your PY is 23-24, I am going to consider immediately preceding that. That is 22-23. 22-23 opening balance I am going to write, and then what is the depreciation charged during that period of 20 to 23? I'm going to consider that, and then I'm going to record my opening balance of the current year, current previous year, relevant previous year. And then whatever is the asset which is been added, which is more than 180 days, which is put to use for a period more than 180 days, I will add here, and less than 180 days, I will add here. That is, I'll give it in a separate basis, so the depreciation becomes easy. And then whatever is sold, suppose let's consider I have sold one. Whatever I have sold, I will subtract it. And at the end of the year before depreciation, what would be my closing balance at the end of the year before depreciation? It would be 86 plus 2, 8, 9, 9 minus 8. So WDV would be so much. If you have got the depreciation, I suppose if I consider my actual depreciation is 3, 5 would be my closing balance. That is after depreciation. This is how I consider. Clear? Now, if you want the notes of whatever you are seeing over here, you can find that in my Telegram channel. The link will be available in the description. So now, when it comes to your composite income is something that is in combination of your agricultural income and your business income. Remember, whatever the turnover you get, this is in total. That is, agriculture income is also there. Professional income, that is business income, is also there. Out of that, you're first reducing all the expenses. Remaining of that income, you're going to take a certain portion. That income will be your business income. Clear? Carry forward and the set off of depreciation. Remember, first of all, you have to give, that is, carry forward of unobserved depreciation is taken in an unlimited term. When we get into the carry forward and chapter, we will look into it. Okay. Now, when it comes to section 35, that is expenses on scientific research, always remember section 35, subsection 1, clause 1 speaks about the revenue expenditure. Obviously, 100% of the revenue expenditure is allowed as your deduction. But remember, it should be related to the business, and also 3 years prior to the commencement of the business, what revenue expenditure which is incurred with relating to the salary given to the scientific research scientists and the employees, plus whatever the raw materials incurred for the purpose of research, that would be allowed as your deduction in the year in which you commence the business. Section 35 subsection 2 clause 1 speaks about the capital expenditure which is related to the business. Capital expenditure prior to the commencement of the year would be considered, and same, the commencement last 3 years, whatever the expenses there, that would be considered for the purpose of deduction. Remember one point, capital expenditure is taken 100% deduction in this section. However, except the land. If you have spent some 10, it's your a capital expenditure. Out of that 2 is land. Only 8 is allowed as your capital, 100% deduction allowed. Land is disallowed. You know the reason why land is disallowed? Because, however, you are not going to take depreciation on land. Hence, you will not get any future deductions in the form of expenses. Hence, it is going to be wrong. Hence, land is going to be lesser. So, if you want more detailed video, there's a separate detailed video revision series videos have been provided. You can go and watch that. Okay, this is sole intention behind doing this video is a revision, very quick revision with regarding to the subject. Okay, amount contributed or paid to section 35 subsection 1 clause 2 speaks about 100% of the amount paid for scientific research or for research associations or for the scientific research, university, colleges and the institutions for that matter. Section 35 subsection 1 clause 2 speaks about 100%, but it is going to be, you are going to get 100% deduction when you have contributed to the company which is registered in India and their main objective is scientific research and development. Section 35 subsection 1 clause 3 speaks about if you're contributing to a research association, to this scientific statistical research, university, college, institutions, etc., then 100% of the amount of such amount shall be deducted. Section 35, subsection 2, section 35 2 AA speaks about National Laboratory, University, Indian Institute of Technology or approved program, etc. Section 35 AD speaks about investment linked tax incentive for specified business. List of the specified business are as follows. See, here, setting up of these are the specified businesses which you can see over here. And the specified business, if you're doing business from this list which is provided, then the government is going to give you a tax incentive. That is, they are going to give you a tax benefit. Now, what are those? What is important out of this is the cold chain facility, warehousing facility, and this warehousing of the sugar. Remember these points, okay? These points, they are given it in the institute material also we have. So please remember these points very carefully. Cold chain facility, warehousing facility, and the sugar. Deduction for the capital expenditure would be 100% of the capital employed would be allowed as deduction. However, the payment is made in cash other than account paycheck, account pay draft for that matter, then it is not going to be allowed. However, 100% of the capital expenditure is allowed. No, that is more important. No. Section 35 AD, if you remember, if you are having 35 AD, if you're taking claiming deduction under section 35 AD, then 10 AA is not available. Anyone you take it, you take either 10 AA or you take either 35 AD. You can't take both. That's it. Section 35D speaks about the amortization of the preliminary expenses. Preliminary expenses are those expenses which are incurred prior to the commencement of the business. Like preparation of the feasibility report, project report, some market survey, legal charges, etc. Some other expenses. This amortization, how you are going to do it is divided into Indian companies and other resident non-corporate tax base. It means other than the companies, whosoever is that they can take this benefit. See, first of all, this amortization 35 section 35D amortization is available in the form of 1 by 5th. Whatever is the qualified amount which you have, out of that 1 by 5th is available for the purpose of your deduction every year. 5 years you will take it as amortized for a period of 5 years. Now, the limit 1 by 5th of the qualifying limit for 5 years is available as the deduction. But what is that 1 by 5th? What is that qualified amount is that in case of other than companies, 5% of the cost of project you can take. In case of Indian companies, you can take 5% of the cost of project or 5% of the capital employed, whichever is higher. What does it mean, Array? What is meant by the cost of project? Very simple. Cost of project means expenses incurred before the commencement of the business, expenses which are incurred for the extension of the business or setting up of a new unit. This expenses which is incurred before the commencement of the business becomes the cost of project. Capital employed means, remember, share capital debenture plus long-term borrowing. All these three combined becomes the capital employed. 5% of this or this, whichever is higher, becomes the qualifying limit. Out of that, 1 by 5th is this going to be allowed as your deduction. Clear? The audit of accounts, it shall be other than the company subject to the tax audit, that is due date of filing of return shall be 31st of October of the relevant AY on or before the specified date. In order to furnish this information shall be 30th of September. You need to provide the, if you're claiming deduction under section 35D, then make sure that you're submitting a statement containing the information about this expenditure to the government 1 month prior to the commencement of the date. That is nothing but 31st October. If it is your due date, you have to submit before 30th of, so on or before 30th of September. Section 35 DDA speaks about amortization of expenses which is incurred under the voluntary retirement scheme. That is 1 by 5th of the amount paid is the deduction which is allowable. Similarly, like your 35D, here also 1 by 5th is allowed as deduction. Whatever is the amount, 1 by 5th you will amortize it for a period of 5 years. Clear? Now, when it comes to section 36, that is other deductions. So, section 36, subsection 1, clause 1 speaks about the interest premium which is paid. That is insurance under, if it is stocks or shows, it is allowable. If it is other purposes, it is not going to be allowable. Now, this is the insurance premium which you paid. First of all, if you paid it for the stocks and stores, it is going to be allowed. Other purpose, it is not allowed. Premium which is paid by employer for the health insurance of the employee. If it is paid in cash, then it is disallowed expenses for the employer. Or if it is paid other than cash, it is going to be allowed expenses. Section 36, subsection 1, clause 2 speaks about the bonus and the commission which is allowed. Section 36, subsection 1, clause 3 speaks about the interest on the borrowed capital. See, bonus in the commission is allowed. Interest on the borrowed capital. Now, you can take these, now, if you are taking a loan, you can take it for two purposes. One for working capital expenses and one for capital buying some machinery for that matter. If you're buying a machinery, you have seen in the borrowing cost, whatever the interest cost which is incurred, it is added to the cost of the asset. No. Similarly, whatever is the interest cost which is incurred till the asset is first put to use, whatever is the interest you have paid for the machinery for which you have taken loan, that interest will be added to the cost of the asset. After that, or apart from that, any other borrowed capital interest which you have, if it is taken for the business purpose, it is allowed as deduction. Now, zero coupon bond, it is whatever the discount that you're given on the zero coupon bond for that matter, the discount is amortized over the period of that zero coupon bond, zero coupon bond lifetime. That is term. Section 36, subsection 1, clause 4 and clause 5 speaks about any contribution which you have made to the funds or anything for that matter, employee. Section 36, subsection 1, clause 4a speaks about employer making a contribution to the employee under the pension scheme which is coming under 80 CCD. It is allowed as expenditure for the employer up to 10% of the salary only. Salary for this purpose is basic plus DA. And this section 36 subsection 1 clause 5 speaks about whatever is the money which is being received, that is whatever is the employer collected any contribution of the employee, if it is not paid within the due date of that respective fund, then it is going to be considered as his income for that matter. It's a very hard provision. Very simple. See, it's an important point. Employer collected some 10,000 rupees as PF contribution of the employee side. He did not pay within the due date of the provident fund, but he paid after some 2 3 months. As he did not pay within the due date of that respective fund, it becomes as income. That's a harsh provision. I'm not speaking about employer contribution, people. I'm speaking about the money which is collected by the employer from the employee's side. Clear? No. Section 36, subsection 1, clause 7, section 36, subsection 2, bad debts. Okay. When it comes to bad debts, remember, bad debts which is actually incurred, it's going to be allowed as deduction. But what bad debts which is incurred and you have already created and you had already uh, created bad debts, but later on, so after certain period of time, that fellow comes back and give the amount. After some 3 years, that fellow comes and gives the amount for that matter. Bad debts, that person is now, I have received the bad debts, whatever I have recovered the bad debt amount. So now what happens is that whenever I receive that amount, that becomes my income. It will be charged as income in the year in which I receive it. Section 36, subsection 1, clause 9 speaks about family planning expenditure. Remember, 1 by 5th of the expenditure is such expenditure is allowed. Bhagavanta, it's only for companies, not for individuals. Remember, it's only for companies. And CA interlevel, they'll test you with the individuals. So remember, it's only for the companies, not for individuals. Section 36, subsection 1, clause 15 speaks about deduction of the security transaction tax and deductions for commodities transaction tax for that matter. Section 37 speaks about the residuary expenses. Residuary expenses, revenue expenses. Residuary expenses means expenses wherein you can't take deduction in the section 30 to 36. You can take the deduction under here, provided it should be incurred for the purpose of the business and it should be for the revenue nature. It should be revenue nature. In that case, residuary case, you can take it. Clear? See, conditions for allowances is very simple. If it is not coming under 30 to 36, incurred for the assessee in that respective year, not incurred for any offense for that matter. Clear? No. When it comes to penalties, remember penalties you have incurred because of breach of contract, that is allowed as deduction. Breach of law is not allowed as deduction. Remember that point. Okay. Expenses incurred for the key man insurance policy allowed. Corporate social responsibility expenses are disallowed because it's not considered for the purpose of business as per income tax. Advertisement insurance of political party is going to be disallowed. However, it is going to be allowed in your deduction chapter 60. Inadmissible deduction, section 40A clause 1 speaks about any interest or royalty or fees for technical services or any such sum which is chargeable. Basically, any interest, royalty or fees for technical services for that matter, wherein you need to make the payment outside India or to a foreign company or to a non-resident for that matter. And TDS was supposed to be deducted, but you did not deduct the TDS. You did not deduct the TDS, or TDS has not been, and TDS has been deducted, but it has not been paid within the due date of filing the income tax return, then 100% of such payment, 100% of such expenditure itself is disallowed, not the TDS amount, 100% of such expenditure is disallowed. However, it can be made correct in the year in which the actual payment is being made. This year 100% I have disallowed. Next year I made the payment to the government of the TDS. Whatever the 100% expenditure was disallowed, no, to that extent, however, how much ever is rectified, that will be considered as your deduction in the next year. Section 40A clause 1A speaks about a similar point. Any sum payable, this was to a non-resident basically, and this is to a resident. Tax has not been deducted, but deducted not paid within the due date of income tax return under section 139(1). People, it's not the due date of that fund, it is the due date of the income tax return. Remember, if you have not complied with it, 30% will be disallowed. Very important provision. If you have made it right in the next year, whatever was disallowed 30% will be allowed in the next year. Clear? Any PGBP, Section 40A, Clause 2, any tax which is levied on the profits or on the basis of the inappropriation, the PGBP, etc. If you have paid any income tax related taxes, it will be disallowed. Any salaries outside India you are paying and TDS has not been deducted, it is disallowed. And any benefits for that matter, if you are paying to the SSC, unless the TDS has been deducted, it is disallowed. Any perquisites which is paid on behalf of the employees by the employer is disallowed. Section 40B speaks about any remuneration or any amount which you are paying, interest which you are paying to the partners in the partnership firm. To what extent it should be allowed and be disallowed. First of all, remuneration to non-working partners disallowed as per income tax. Remuneration to the working partners but not authorized by deed is going to be disallowed as per income tax. Remuneration to working partners or the interest basically to an earlier year. See, remuneration paid to working partners or the interest paid to the working partner authorized by deed, but it is not for the current relevant previous year, it is for the earlier years. It is going to be disallowed. Interest up to 12% is going to be allowed as deduction. Excess of 12% is disallowed. Remuneration can be paid, but how the remuneration payment should be made is that on the first rupees, on the first 3 lakh of book profit or in case of loss, 1,50,000 or 90% of the book profit, whichever is higher, should be considered. On the balance book profit, 60% of the profit should be considered. Very simple. See, if 10 lakh rupees is the remuneration, sorry, 10 lakh rupees is the book profit which you have, up to 90% of this one, up to 3 lakh rupees, 3 lakh into 90% leads to 2 lakh 70,000. No, 2 lakh 70,000 or 1,50,000, whichever is higher. 2.7 is what I will consider. On the balance, that is on the balance 7 lakh, I will take 60% over here. I will add these two, and this one and this one I will add. This one and this one I will add, and I will record over here. Clear? Now, expenses or the payments not deductible in certain situations, that is 40A2, wherein the payment to relatives and associates are made, but it is in excess of the fair market value, then it is going to be disallowed. Very important provision. Section 40A3, wherein payment in excess of 10,000 rupees is made other than account paycheck, account pay draft, or any other clearance mode per day per person, then it is going to be disallowed. Section 40A3 states that at limit of 10,000 is increased to 35,000 in case the payment is made to a transport operator for flying, hiring, or leasing of any goods carriage for that matter. Now, Section 40A7 speaks about disallowance of provision for gratuity. Disallowance of provision for gratuity is very simple. Whatever is the provision that you created for the gratuity that you're going to add back, actual gratuity paid will be allowed as your deduction. Section 40A9 speaks about the contribution of the employers to the funds of the trust, etc. It is going to be disallowed. Section 41, whatever is the remission, trade liability which you have foregone, which that fellow has forgone, now becomes your income. If someone gives you 10,000 rupees as loan and after some 3 years he says that don't give the 10,000 rupees for that matter, that when that fellow said after 3 years, that is, don't give me this loan of 10,000 rupees, it has become your income at that point of time. That is what it is speaking. Trade liability, remission or cessation of the trading liability, it is going to be taxable. Clear? Any bad debts recovery is going to be taxable. Any brought forward loss of some non-existent businesses, you have considered some brought forward loss, then it is going to be considered as taxable. Clear? Section 43A speaks about if there is any changes in the exchange of currency, that is increase or decrease effect is happening, then that effect can be given in your income tax in your PGBP as well. Section 43B says that any deduction, certain deductions are there wherein certain expenditure you have to make the payment. Actual payment, if you make, I'll give you actual deduction. If you don't make the actual payment, then we are going to not going to give deductions. What are those? Tax duty says, etc. Any contribution which you are making, employer contribution to provident fund or some gratuity fund, any interest, bonus or commission, any interest on loan or borrowing from any public institution, interest on any loan or borrowings from any notified class of NBFC, interest on any loan or advance from the scheduled bank, some paid by the SSC as an employer in the on the name of his employee, and some payable by the SSC to the Indian Railway for use of this railway asset, micro MSME people doing the business wherein they have not received the money within this 45 days and 15 days for that matter, then it is going to be considered as deductions. If you actually make the payment, deduction is available. If you don't make the payment, deduction is not available. When it comes to conversion of interest into loan or borrowings, no. See, what happens is that you have taken a loan of 10 lakh. You did not pay the interest. Interest accumulated is 5 lakh. Now you are going and telling bank, now I want the earlier loan which I have not paid. Interest which is accumulated, convert that into a new loan. I will make the repayment within 25 months of 60,000 rupees each. So it means is making the payment of interest also as a new loan, which is covering 33%. How did you get this 33%? Very simple. 5 divided by 15 lakh, and this 10 lakh divided by 15 lakh, you got so much. So 33% of his EMI payment which is making can be taken as deduction. Is allowed as deduction. Simple. Section 43 CA is a very good section wherein it states stamp duty value of land and building only to be taken as the full value of consideration. Basically, what happens if you are taking for the land and building, you have stamp duty value. No? People might fix the sale consideration one, and people might do the actual transactions in some other amount. In paper, they can show it as some 40 lakhs, and outside they might be dealing for 70 lakh. They'll pay the tax only for that 40 lakh, or whatever the capital gain comes in. So what they did, one thing we'll do, which is simple. Whatever the stock in trade we are considering as the land and building, however, we have that STV. No, we'll keep that STV as the base. How? See, if your STV is up to 110% of the consideration, then your sale consideration becomes your full value of consideration for the purpose of your PGBP computation. Clear? If your STV is greater than 110% of the consideration, then your STV itself becomes your consideration. If you want the more detailed explanation of the section 43 CA, it's a separate video which has been provided in my in the channel. You can go and watch that classes, and the link to this 43 CA will also be provided in the description. You can go directly and watch the class. Okay. Where the date of agreement and the date of registrations are not the same. See, date of registration can be one and the date of agreement can be one. In that case, what will happen is very simple. Whatever the part, if you have paid it in account pay check, account pay draft, whatever the advance payment you have made, then the sale consideration in that the time of sale consideration, SDV as on the date of agreement becomes the SDV as on the date of agreement becomes the SDV for the purpose of calculation. If you have received it in other modes, example in cash, then SDB as on the date of registration would become the sale price SDB for the purpose of calculation. Clear? Section 44 AA speaks about the compulsory maintenance of books of accounts. Compulsory maintenance of books of accounts, who should maintain section 44 AA. Clause 1 speaks about the notified professional, legal, technical, medical, interior decoration, engineering, film artist, agriculture professional, compulsory, this company secretary, information technology professionals, etc. All these people come. So what is the point that you're considering is that cash journal, ledger, carbon copy. Now, when it comes to the prescribed books of accounts or other documents which are supposed to be maintained, they have to maintain, the notified professional should maintain cash book, journal, ledger, carbon copies, original bills, etc. Okay. Section 44 AA subsection 2 speaks about who should maintain the books of accounts other than the notified professionals which are provided over here. Other than this, who should maintain? See, person carrying on any specified professions for that matter, and their gross receipts in the transaction if exceeding 1.5 lakh in all the three immediately preceding previous year, not the PY. Preceding the previous year, last three PY, all the years they have exceeded 1.5. Any 1 year, if they have not exceeded, then they will not come under this category. Clear? If they have exceeded in all this, then they have to maintain the books of accounts as per rule 6FF. Okay. If they have to maintain the gross receipts in the profession and it does not exceed 1.5 lakh in any one of the immediately preceding year, then they have to maintain such books of accounts where the assessing officer can compute as calculation, can compute as income for that matter. So, a person carrying on non-specified business for that matter, here what happens is that here, in case of profit, if they consider profit, profit if it exceeds 1.2 lakh, and in case of individuals and HF 2.5 lakh, or the sales of the turnover exceeds 10 lakh, and in case of individuals or HF exceeds 25 lakh, in any of the three preceding previous year, in any of the three, so any of the three preceding previous year it has exceeded, maintain such books of accounts. It is necessary for the assessing officer to maintain, to say, okay, so much is your income. If it is not the case, any one of the previous year it is not exceeding, not required to maintain the books of accounts itself. Okay. Now, so in case of section 271, it speaks about a penalty to for failure to maintain the books of accounts. That penalty is 25,000. Section 44AB, which is very important, wherein the audit of the books of accounts need to be considered. Yes, section 44AB, wherein the tax audit, it's a requirement of the tax audit. Tax audit is necessary when the person is carrying on in the business and its turnover is greater than 1 crore in the relevant in the respective PY. Its turnover is greater than 1 crore, and in case of profession, if it is greater than 50 lakh rupees for that matter, then the tax audit is necessary. It's 1 crore for the business can be replaced to 10 crore. 1 crore can be 10 crore. That is 1 crore can be 10 crore. 1 crore is replaced by 10 crores in case it satisfies both the condition. It is both and clause, remember. When the cash receipts in the relevant to PY is up to 5% and the cash payment is up to total of 5% of the total payment and the total receipt. In the cash payment, cash receipts, not cash receipts in total is up to 5% of the total receipts and the cash payment in total is up to 5% of the total payment. In that case, you can 1 crore will be replaced with 10 crore. You need not get your books of accounts audited. Payment or the receipts are not in the account paid check for that matter. It is going to be considered in cash. Remember, section 44AB is not applicable if section 44AD is applicable for you. Okay, what is section 4480? It's a presumptive taxation wherein a relaxation is given to the business wherein for individuals HUF, AOP and this partnership firm doesn't include LLP. Individual, HUF and partnership firm, not AOP, partnership. It is not applicable in case the people are coming under 44AA notified professionals. People who are earning income in the nature of commission and brokerage can't take this section 44AD. People carrying on any agency business, people carrying on the business of flying or hiring of leasing of goods carriage under section 44A can't come up. Turnover eligibility, that is turnover up to 2 crore rupees can't be considered. The estimated income, that is turnover or the gross receipts income for that matter, through bank is 6% of the turnover. And in case of the other mode, it is 8% of the turnover. I just need to show out of my total turnover, I just need to show my 6% as my turnover if the transaction is through bank. If it is other than bank, example in form of cash, 8% of the turnover if I show, this will be my income which I have shown. The turnover will be up to 2 crore. Up to 2 crore I can show 4480. Excess of 2 crore I can't show under 4480. Section 44ADA speaks about the presumptive taxation wherein the eligible assessee, that is individual resident individuals, HF and the partnership firm, which is not LLP again. If the gross receipt is up to 50 lakh rupees, then I can show my income under section 44AD. I can show my business, that is my profession under section 44AD. And the income which I should show should be minimum of 50%. It should be minimum of 50% of my gross receipt. Section 44AE speaks about business of flying, leasing or hiring of the goods carriage, wherein the eligible assessee are all assessee which are engaged in the business of flying, hiring or leasing of the goods carriage, and the conditions for that matter shall be assessee that fellow should not own more than 10 goods carriage at any time during the period. The estimated income shall be heavy vehicles, and how we are going to show their income is that for heavy vehicles, Heavy vehicles means which is crossing exceeding 12,000 kg. The estimated income shall be 1,000 per ton per month or part of month. Even in single month, single day, this machinery is being used, we are going to consider it as one full month. And for other vehicles, it is 7,500 per month fixed or part of month, or the actual expenses, whichever is low that you would consider. In case of agriculture, income treated as partly as business purpose and partly as your business in nature, partly as your agriculture in nature. How you are going to treat is that income from sale of rubber or income from the sale of rubber specifically. Business income shall be 35%, agriculture income shall be 65%. Income from the sale of coffee which is grown and curd by the seller, 25% in case of business income, agriculture income 75%. Grown curd, roasted, grounded by the seller, 40% in case of business income, agriculture income 60%. Income from the sale of tea grown manufactured by the seller in India, 40% in case of business income, agriculture income in case of 60%. This is your PGBP revision.